This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high-yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASX-listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing. I'm proud to say that this Rask podcast episode is brought to you by PIMCO, one of the world's leading fixed income investment managers. With more than 50 years of experience in navigating complex global markets, trillions of dollars under management, and a global team of experts, PIMCO is a name trusted by investors worldwide. Discover how PIMCO can help you build a more resilient portfolio at pimco.com/au.
Hello everyone, welcome back to the Australian Retirement Podcast, your source of financial goodness to your ears every Thursday. Drew Meredith, good to see you, mate.
I'd love to say live. You always bring so much energy. It makes my energy have to go up as well.
You've got this look about you right now that's like, it's very dapper, but it's also got a bit of witness protection program about it. Can you talk to me?
It does look a bit like a tactical jacket, doesn't it? This is what's known apparently as a shacket. Mm-hmm. Half shacket, half shirt, half jacket. Mm-hmm. And it's good for those kind of in-between winter months or between spring. You know, it's still a bit cold outside, but you don't want to go, full rugged up. Plus Owen stole my coat for about 3 weeks. I left it, very fine line to negotiate. But thank you.
You're welcome.
I can shout out to a very good tailor in Collins Street, Houndstooth, who makes some amazing stuff.
Well, let's kick in. Let's kick on, rather. Get started, jump in, whatever we're doing. We have lots of good stuff to talk about today. But the first thing that we've got on this list to talk about is it's Palm Cove.
What a wonderful place Palm Cove is. I had the pleasure of spending a long weekend, so like a Thursday, Friday, Saturday, Sunday, come back Monday in Palm Cove. So for those who don't know, it's about half an hour north of Cairns International Airport, apparently, which I found out on the way back.
That is not an international airport.
It's an international airport. We flew into the international terminal back to Melbourne. It's surprisingly really good for a weekend. Didn't no children this time, but for children, amazing. They have the pool at the Peppers, and it's not about my holiday. There's actually a different story here.
I'm living this.
It's full of sand. It's got a fake sand pool and then a swim up bar. So something like you would have seen in Bali, probably. The king of Bali over here. But it wasn't that. It was more. So I've had clients that have invested into these holiday apartments in the past, and to see it in real life, IRL, is that what they say?
Yeah, it is. Yeah. Good on you.
But
Look at you
just
your colloquialisms, yeah.
A beautiful place. Weather was amazing. 28 degrees every day. Perfect time to go there before the wet season starts. Great. No payment from Palm Cove. But it's quite interesting because when we booked, you don't book through the hotel. You can book through the hotel, but the hotel charges twice what you can get if you book directly. So you go through something like booking.com and they're basically managing agents are then leasing out properties that a lot of people, I understand, have bought as investments as part of this complex, which are no longer managed by the hotel. So you've got this kind of weird thing where some rooms are getting service and they're sheets and all that sort of stuff cleaned, and others can't even get extra towels. Yeah, you just turn up. It makes it obviously a lot more affordable, but it also brings up, timeshares. You go up there and it'd be amazing. We should buy an apartment here. And then you always think about those things. But it kind of highlighted things probably similar to owning apartments, whereas all the common areas start to struggle. There's difficult to get investments from multiple, the place was okay, but looked like it hadn't really had much done for 20 years in certain areas. So it's this difficulty of owning these type of semi-lifestyle assets in retirement is something I found kind of quite unique, and I've had the experience of trying to help a client sell one. And how do you price something that's in a controlled environment, and then you don't know if they want to do a paint job, then everyone has to do a paint job. If they want to, I thought it was quite very interesting, and kind of gave me some insight into that. But also you get the smart people that get the Woolworths delivery out the front. The Woolworths guy comes past the pool and it's like the perfect holiday idea.
I reckon that similarly, I've seen some people with these like Palm Cove, but then also in Melbourne buying these sorts of apartments like through Quest. I've actually never seen the story end well in a financial sense. Like the lifestyle decision to go up, sure. Gemma Mitchell in a recent podcast, she was talking about try before you buy. You know, like how often are you actually going to use this really? And if you, I think in most cases with these things, you're probably going to start by spending a year paying a premium. Let's just go and rent it and just see how many times we rent it, and is this level of use sustainable, and then let's make a case for it.
And they sell them on a pretty attractive income. Like they say that your income's 6 or 8%, but in most, I've never seen someone make a profit out of them. You know, like
the capital,
be able to sell, like this value of the capital going up at all. It's not like, there's always going to be 10 for sale if there's 300 apartments. So it's like it's hard to have an inefficient market where people are trying to get in or trying to get out. So I mean that's something that comes up regularly in investments, that people like it's sold with a very high income, but in a lot of cases that means the asset's depreciating, or you're going to have to put more money into it just for it to keep up with what's going on elsewhere. Yeah. And I'm not getting nervous at all. No, James, I'm fine.
Yes, you are. Come on now. We're talking about the CBA share price, this season-long bet that we've had for, I think it was a Savlaki, something similar. And
it'll be increasing as it comes off more.
The share, it'll flip. It'll flip as we get close. We've seen the CBA. Let's just say it's starting to trace back to what we describe as reasonable valuations. We're down at once.
You would describe as a reasonable valuation.
And most importantly, it's happened. It's the miracle for me because the ASX broadly has actually performed pretty well over this time. CBA share price is now 168. It was 191. It's now at 168. There's 3 months to go, 4 months to go. We've got to get it below 153.
It's only just over 10%.
That's right. So this is my first offer. I'm going to let you out
to go below 153.
I'm willing to let you out of this bet for like for a coffee and a muffin.
I'm doubling down. This is going to be a late year rally, and for those that listen to the Australian Investors podcast as well, I'm under a bit of pressure under that one as well. My fake news portfolio, my fantasy portfolio, is doing well, but has been trumped by Owen's takeover.
There was an IPO there.
Offer, we'll call it. Yeah, whatever you want to call it. Start talking it down. Hopefully people listen. But I mean, it's been pretty significant. And this is a company all the way up. It was said it was too expensive, and everyone was expecting it to sell. And now all those people probably feel like they're right, even though they probably called it was going to fall off at some point. It's still like off 10, 12%, 12, maybe 12, 15% from the high. And still, I mean, I've still got 10% buffer. So no, I will not accept your offer. And I know you'd probably end up getting like a pour over cold brew, $27 coffee anyway. You do something like that to me with some niche macadamia milk or something in there. But I've still remained comfortable, still the best. They say it's the most expensive bank in the world. It's also the best bank in the world. I don't bank with them, which is quite interesting. Best bank for advisors, Macquarie.
I'm looking here at the Morningstar research for
let me
CBA.
guess. It's got to sell.
No, I just love the wording on it. It says, Commonwealth Bank earnings, no surprises, share price keeps us puzzled. So,
but
value
go to the history of
two,
Morningstar.
When
was the last time Morningstar had a buy on CBA?
To be fair, they have increased their fair value estimate by 2% to AUD $100. Yeah, so it's got a bit to go. But yes, agree that Morningstar can sometimes be a little bit too fundamentally driven.
They've ever had a buy on it.
Yeah.
But they love European banks, so it's always incredibly.
Do you mean they love banks that
that are 10 times PE, that don't grow or something like that? Yeah.
All right, let's get moving. When are we going to get out of here? We're talking about deeming rates.
Short on this.
Deeming rates have changed, right? Big news.
Yeah, I think there was a lot of big news, and this is the twice annual reset, or not necessarily resetting deeming rates, but twice annual resets of payment rates and Centrelink, age pension, all those sort of things that come out. So we've got one upcoming on the 20th of September. Again, warning, this is not my specialty, so I don't always know the intricate detail of this area. And as you'd expect from an advisor, they specialize in different areas. But the deeming rate is the percentage return applied to the cash, shares, other assets that you have that is then added to the income for your income test. It also applies to superannuation balances that are in retirement phase, so where you're drawing a pension. But if you're not drawing a pension, as we know, and you're still in accumulation phase, even if you're over if you're under 67. Yep. I'm just trying to remember that age pension date. Then it does apply after that age. So what's happening there is the government's quite quick at increasing deeming rates after interest rates only went up, probably 3 or 4 months ago, aren't they? Went down, sorry. It's kind of this revert. I don't know. It just seems, some of it just seems counterintuitive, doesn't it? So the deeming rate will increase from 0.25%, which was pushed down in the pandemic to that level from memory, when interest rates were cut to zero, jumping it from 0.25 to 0.75. So they've waited 2 years since interest rates started to increase to make a change to it. And that's for assets below the threshold, and those thresholds are $64,200 for singles, so for single people, and $106,000 for couples. So if you got your total combined assets will be applied an interest rate of 0.75%. You have to include that in your income test. As soon as you go over that, it's going from 2.25% to 2.75%. So the same 50 basis point jump in the financial lingo, 1 basis point being 0.01%, which can have a significant impact. If you've been holding on, term deposits been doing better, you've got 100, 3, 4, a lot of people have lots of money in term deposits, then you're going to be penalized an extra just under 25%, so like 20% increase of the income that you're going to have to include in your income test. So pretty significant change.
It is.
So they've been holding on to that one for a while.
Yeah, and it's not good news because, of course, the more your income levels are higher, according to Centrelink, commensurately, the lower your pension may be, depending on whether your income or asset tested. Or you could lose it. Yeah. When it comes to these deeming rates, the byproduct of all of this, let's take a real scenario where you might have all of your money hypothetically in gold bullion, which would be a crazy scenario, but indulge the hypothetical. That's not actually earning any income. That is a fixed asset. There is no income whatsoever. But Centrelink takes the view that, well, even though the money is not, like this asset is not deriving any income, we're going to imagine that it does.
That you could be using it.
That's right. And so that deeming rate, if you had, let's keep numbers really, really simple, you had $100,000 of gold bullion, and let's imagine for simplicity it was over the initial rate, just so we keep our numbers really simple, that'd be deemed at 2.75%. So Centrelink would say, well, you're earning $2,750 of income from the $100,000 of gold bars that you've got sitting there. Whether or not it's coming or not, that's just the assumption that we have. Now, conversely, you might have an investment that actually is paying an interest rate that's substantially higher.
7% from a share portfolio.
Yeah. And similarly, Centrelink will still take that same approach of saying, well, we just deem it at a flat rate of 2.75, ignoring, again, the initial threshold, and that keeps things relatively fair.
And that's quite unique, isn't it? Because you can it'd be very difficult for the Centrelink, for the federal government, to be able to assess all these different types of situations, and it does bring into this idea that if you're being deemed to earn that level of income, you want to be trying to get as much income as you can on top of that from those investments as possible.
Absolutely,
income or growth, whatever it happens to be.
Go and buy that timeshare investment at a 10% yield.
There's no growth assessment, but obviously the growth is caught up in the assets test. Go buy the timeshare and boost that income. I think that's super interesting. But they're doing other. There's other changes coming as well.
That's right. The Lord giveth and the Lord taketh away. So the taketh away is obviously the deeming, because that's going to create inferior outcomes for a lot of Australians.
Is the government trying to reduce payouts?
No, because at the same time, they're looking to increase pension payments. Now, we've spoken before on the show about how, broadly speaking, those age pension payment increases have been grossly insufficient in order to ensure that Australians who are on full age pension have an adequate standard of living. But it is nice to see that there is an increase happening here. So at the moment, if you're single and earning more than $2,500, just a smidge over that, then you won't be eligible for any age pension at all. But from September the 20th, that limit is going to go from $2,516 to $2,575. So it's about a $60 increase per fortnight you can earn. So that equates to, let's call it $2,000.
Yeah.
Not quite. But we'll use that number broadly.
And then assessable income, which doesn't include your superannuation.
Correct. And for couples, it goes up by about $90. So about $2,500 or thereabouts. So it's nice that the byproduct of this, it's sort of the deeming is going to result in a lot of Australians being tested for more income, but then similarly the income test is increasing, which is going to mean that it's going to largely offset the two of those.
And I'm sure they could basically run these numbers as a government department and see what that impact's going to be before they even do it.
Yeah, correct. And similarly, the assets test is increasing too, mindful of time, but we're seeing homeowners can, the part pension previously 1,059,000, non-homeowners 1.332 million, and that's continuing to increase too. So pleasing stuff. And broadly speaking, considering that not everyone is income tested, most Australians are actually asset tested on the age pension, given that it is likely to result in more pension for most Australians.
And this is one of the reasons it's so important to constantly update. So download your MyGov, log in, link it to Centrelink if you're using it, and basically always update. Get the most fresh information always, so you're getting the most accurate assessment. That means if you're getting too much, you're not going to get an unexpected invoice. But at the same time, if you're always making sure you're getting enough, or as much as you're entitled to.
Thanks for watching this episode of the podcast. A common question that we get at Rask is, how do I need to be prepared if I want to see a financial advisor? There's a few things that stand out that may really help you if you want to get the best from an advisory relationship. The first is to come prepared. It's really valuable if you can arrive at that meeting with a good sense as to what you want to achieve from an advisory relationship. Now, there's lots of different financial advisors out there that operate very differently. And if you don't have a good sense as to what you want to achieve, it can be kind of easy to get pulled into their advice philosophy and their approach. It can be hard to define what is the best advice relationship for me. So whether it's you or you and your partner having a good conversation to say, what do we actually want to get out of this? That will really, really help you to know that you're in the right place when you sit down with your advisor. The second one is to be open-minded. You may very well work out that there is one or two specific things that we're looking to address with our financial life. But a really good financial advisor is going to be thorough. They're not just going to look at those things. They're going to be as exhaustive as they can be about your entire financial life and make sure that everything is lined up and set up the way that it should be. So when you go into that process, please be open-minded that the highest value that you might get is not necessarily solving those one or two acute things that you wanted. The last thing is to be curious. If you are watching this podcast, it's probably because you are watching or listening. It's probably because you want to learn more about your finances. You want to level up when it comes to your education. And if you're going to meet with a financial advisor, it may be your first opportunity to transition that general knowledge that you've developed about your finances into your own situation and how it applies to you. So be curious. It makes sense for you to try to understand as well as possible, how do all these things work for me? Because at the end of the day, it's your financial journey and it's your money, and all of the advice should be helping to serve your unique situation. Now, if you want to learn more about how to get the most from your advisory relationship, you can either scan here, and that will take you to a guide that gives you a heap more information. Alternatively, if you scroll down below, there is a link to a Northeast Wealth page that we put together not too long ago, and that similarly outlines the key things that you should be doing in order to get the very most from the relationship. Thanks again for watching this episode of the podcast. I'm James O'Reilly from Northeast Wealth. We hope you enjoy it. Let's move across to our boomer briefing.
Yeah, gosh.
And we're going to talk today about the schmozzle that is the Dixon collapse. Now, the Dixon collapse happened a couple of years ago now. For many of you who perhaps might not be across this, there was a financial advisory practice called Dixon Advisory. Predominantly, they did a lot of work with self-managed superannuation funds, and their approach was, unfortunately, to steal. Hang on, let me make sure I get my words right. Steer is the correct word. Good heavens.
When they can't sue you, so that's fine.
Yeah, that's true. Was to steer a huge amount of their client money into their own products. And this created some massive conflicts, particularly as those products became really inferior. US
unlisted property, private equity, some of them, and this is similar to, you probably heard the Blue Sky story as well. There's some of these things that have done well, like there were investments in there, but it is incredibly complex, and it was as it's come out since, it's was a conflicted model. Clearly, it was called Evans and Dixon's at the time, and then I googled Evans and Dixon's, and it's a full service litigation law firm overseas. And I'm like, well, they're the only ones that made money. Definitely, but it's been shocking. So they have cancelled. They had not a royal commission, but they had a commission or inquiry. I'm not sure the terms and the differences.
That's right. So what happened here, aside from this huge, massive failure in the financial advisory sector, what happened here is that just before Dixon's failed entirely and they went insolvent, they transferred about 80% of their clients, which, as I understand, was about 3,200 clients. You might have a different number.
They said about according to, I believe it was AFCA, said about 4,500 former clients of Dixon. So it would be around that level. We don't know specifics.
So they transferred about 80% of its client base from Dixon. Dixon has a parent group called Evans and Partners, and they transferred all these clients out of the Dixon company,
which was into administration,
into a new entity. And they did that only just a fraction of time before the whole thing blew up. Now, the byproduct of that is that Dixon's then collapsed. There was no value left in the company. So then when these clients went to AFCA, Evans and Partners, who were the parent company, said, well, this company, Dixon, has no assets, doesn't have any clients, it doesn't because you've swept them all out into a new entity. And so therefore, all of these people missed out on their full entitlement, or many of them did. Yeah. Now they went,
we paid for it.
Yeah, if you go, what happens here is if you go down this channel, then you've got, initially you'd go to AFCA, Australian Financial Complaints Authority. They would determine that the advice was inferior, which is what happened. And then they would seek that there'd be a determination as to how much you should be paid or remediated for your loss, which would normally be the full amount that you lost.
Yeah.
But then Evans and Partners was able to say, well, Dixon's can't pay that because it's insolvent. So then the next step is that then it goes to what's called the compensation scheme of last resort. And then the compensation scheme of last resort will remediate as much as possible the delta between what they were paid versus what they were owed, to a limit of $150,000, if I recall
something
correctly.
Like that, yeah.
And so what actually happened here is Evans and Partners has taken almost this entire business, moved it out of this company that they know is about to explode due to their own terrible management into a new company. I'm so angry about this. Into a new entity, and business as usual. Let's keep going. Transferred advisors, clients, everything across so that this company would be insolvent. And then let's get on with it. Business as usual.
And all those people had to agree to that, though. You can't just be transferred.
Yeah, that's right. And I'm led to believe that, correct me if I'm wrong, the promise for these clients who were moving from entity A and entity B was free service for a period of time.
This is for the people we spoke to. Like, I've spoken to people directly, and that was basically to bring them over, that there was essentially no cost for a bit of time. And this is people who, and this is it's great to talk about it and have a little whinge and vent. But again, how does it end up happening? It's like, that's where the bigger question comes in. And I think you remember Dixon was in every newspaper offering something like $800 tax returns for your SMSF. They were leading with something. They weren't even leading with investments. They were leading with something incredibly cheap, and something SMSFs were more popular. I think maybe this is one of the reasons they're less popular, but something incredibly low cost. And there was always a bit of fine print that's only you have to use a certain bank account or something. But what ended up happening is that I've personally seen clients that had 40 to 60% internal issued products within their portfolios. And they're ones we've went through with AFCA. We're lucky enough to put the complaints in, identified and put complaints in earlier, and got paid out significantly. But the problem, the broader public will never know all of this, apart from those people listen here and read parts of the Fin, because that inquiry has been shut down. That would have seen a lot of coverage in the mainstream press, not just the financial press, where a lot of the focus has been.
That's right. So following this absolute abomination, the obvious question is, how can we let that be? How can we let a company like Evans and Partners intentionally transfer their entire business across to avoid being responsible for the financial costs that they've ultimately commandeered?
Yeah.
And so what the recommendation was that there should be an inquiry, a Senate inquiry, based on how this happened, and ultimately making sure it doesn't happen again. Now, what also makes my blood boil about this is that this has happened again. We've seen very recently, Shield, First Master, or First Guardian. We're seeing these issues or variations of these issues rise again. And despite this, the Senate has abandoned the inquiry and decided that it's not a priority based on where they are. And that beggars belief.
And the problem here is that the Commonwealth's the compensation scheme of last resort is that as the name suggests, that final way of getting some sort of money back for where poor advice has been provided. But the problem for us is that we pay for it, and we're assessed on how much essentially they're going to need. And we pay per advisor, so as a business and per advisor. So if we're growing and adding more advisors, we're paying more into the compensation scheme, even though we've never had a complaint, and even though a group of however many advisors transferred businesses, and it hasn't been dealt with. We're wearing the cost of this as opposed to the company that was involved.
Correct. Yeah.
And that's where the uproar is. And that's even worse when the number of advisors is halved from 28,000 to like 14,000, which means the number per advisor.
The number is higher.
Yeah. Another one of those costs that keep increasing, and it feels like it's unique for industries as well, that
they self-fund.
The industry funds it. Yeah.
Yeah. Look,
supposed to be social license.
I suppose I'm mindful of time. Let's keep moving, but I support that concept. Like the CSLR, like there should be some mechanism in order to make sure that consumers are well supported. And unfortunately, these bills can rack up into the hundreds of millions of dollars because of the level of failure that can happen for, for example, a Dixon or for a First Guardian. But this is a classic example. The idea that Evans and Partners has no recourse, or there's no recourse to Evans and Partners in this scenario, despite the fact that they very consciously transferred money out of there. That for me it's the ultimate insult. Are we actually serious about regulating this profession? Are we serious about trying to get to the bottom of these problems and make sure it doesn't happen again? And the regulator always says they got their hands tied, like they can only follow specifically on legislation. And when complaints happen, they can execute. They can't be proactive, which feels like the SEC. Maybe it's just the movies in the US that they seem to be more proactive on stopping things as they're occurring. But they need all the evidence before they can do anything. Yeah. We need to be a lot more serious about this. If we are to earn the trust of Australians the way that in the manner with which we aim to do, we need to have regulation that evolves with the problems that we run into. All right, let's move on to today's big question. It comes from Deterred Whim, and the question is about family trusts. So I am looking at setting up a family trust for my investments. I've been speaking to my accountant about this, and while they've got some ideas about it, I'm not really clear on what the main benefits are and also the main consequences. Can you help me? Yeah, I reckon we can.
Yeah, I think this comes up quite often. I think we recently recommended a family trust for someone, and their accountant quite quickly said a no-go on it, but didn't have much explanation. And sometimes that's because the accountant is, trying to defend their turf when we get involved. But this was someone with significant assets. They had fair bit of money in a company. Their superannuation was near the caps, and this extra structure started to make sense. But basically, to understand what family trusts are and what the benefits are, you're going to have to understand what they're not. So when you're investing, that's a nice way to answer a question.
It's not a dinosaur.
Yeah. It's not it's not a hippo.
Let's start there.
Yeah. So when you think about when you're investing, the most two common ways, you're investing in your own name or joint names, and then say your superannuation fund. They're just the little wrappers that you're putting these assets into. Once you get to there, you can get a bit more creative. The two other real options, and I'm sure there's more, but these are the most common ones, is a company. So investment company, you could run a business in that, known as a PTY Ltd. They have a tax rate that's around 27.5%, depending on passive income versus active income. But basically, the tax is paid within the company, and the company has to declare dividends to get the money out. A family trust is completely different to all these, probably more like a superannuation fund in that it's a pass-through entity. So once assets are in a trust, that trust, and in most cases, what's known as a family trust is a discretionary trust, which means when you've got assets in a family trust, and there's another story about how they get into there, they must be every capital gain and every income, every piece of capital gain, every piece of income must be distributed from that trust each year, or be taxed at the highest marginal tax rate. It's very similar to the way an ETF works or a managed fund works. As you know, if you had the S&P 500 last year, you got a big distribution after June because it had to distribute everything. If it sold anything and realized capital gains, it all came out. So basically, it's a pass-through entity, but allows you to hold investments and have some level of asset protection. The trust is the beneficial owner, and the beneficiaries are at the discretion of the trustee, which means they can receive different types of income and different amounts in any given year. I think there's a few things here that are worth covering. One is that it offers that flexibility to stream income. That is, if perfect example, this couple, they were working kind of casually, so sometimes their income would go up and down. They had money in their company, they didn't want to pay dividends from that, they had money in the super fund, and they were just holding the rest in their own name. So basically, if they started investing into a family trust and they made $50,000 profit the following year on their capital gains or they received income, they could then decide before 30 June who they wanted to distribute that income to. So if husband didn't earn anything, decided not to work that year, wife is earning $80,000, naturally it makes sense to distribute the $50,000 to husband, and this is the benefit. That's why it's called a discretionary family trust. There is a drawback though from tax consequences, I feel, from a tax perspective, and I feel like I've been talking non-stop. So what's one of the challenges when it comes to tax for a family trust?
Are we going down the personal services income line, or are we talking about specifically
more the entity? Yeah.
Well, if we're looking to distribute money, one of the obvious things to think about is who can we distribute it to?
Yeah.
So let's imagine, for example, that you are a self-employed individual, you're single, you don't have adult children or parents or relatives that you either are inclined to or can distribute to. In that scenario, having a family trust might, for all intents and purposes, create zero benefit for you.
Yeah.
Because, as you said, it's passed through, which means that all the income that is received through the trust, even if you're
straight to you,
it's still coming straight to you anyway, because there's no one else to go to, and therefore there's not really any benefit. So you want to have, assuming that you're doing it for the tax benefits, you want to have enough beneficiaries available to distribute that income and have a lower overall tax position than if it were all just coming to you directly.
Yeah, exactly. And then you have the other problem, which comes up quite often because a lot of people want to, say, buy a property within a family trust, and a lot of time property is negatively geared. So being a pass-through entity, family trusts also can't distribute losses. So if you make a capital loss in a family trust, it has to stay in the family trust and be offset against future gains. And similarly, income losses can't be distributed so you can't use an income loss like you would if you were negatively gearing from a trust. It actually has to stay in there and be offset by future income, which is quite often forgotten. And as you were mentioning, personal services income. So people in some cases think that it's okay that you could run a business as a family trust as the operating entity, but the business is all you, you're consulting, and all the income is produced by you. There's very specific rules around it, but basically a lot of that income then is deemed to be personal service income and has to be included as marginal tax rate anyway.
Yeah.
That's those kind of circumstances where it doesn't specifically work.
We see this a lot of the time for people that work in IT, for example. You might have an IT consultant that's self-employed. Running through a company. Contracting is very popular in the IT profession. And so therefore you'll have one employer that's paying a couple $100,000 a year, for example. You think, I'll set up a family trust, easy, and then I'll pay it to the family trust, distribute it how I like. But that doesn't work in that scenario because it can be deemed that all the income is coming directly to you, and it's because of your personal exertion. Now, conversely, if you had maybe your time is split across 3 different employers that all are employing you at various rates throughout the year or various hours throughout the year, that environment is going to be much more likely to enable you to say, well, I'm not just employed by one employer, and the circumstances are such that not all of this is personal services income, so therefore I do have the flexibility to distribute to a partner or family. Now, there's one other thing to add here, which is around when you distribute the money, the ATO is increasingly becoming more focused on the idea of did they actually get the money?
Yeah.
If we go back 15 years, distributing the money was just essentially saying, Hey, Dad, can I ship you $20,000 on paper, and you might require there'll be a tiny little bit of extra tax you pay, and I'll foot the bill for you, and that's going to save me $9,000.
Yeah.
And your dad would say, "Yep, no problem," and so you'd get that done. The ATO is all over that now. They really want better paper trail, and then ideally to demonstrate that the money has been indeed passed across and paid.
Yeah.
And I recall that there was a case not too long ago. Actually, I say it maybe 4 or 5 years ago, where a couple separated. One member of the couple had very high income through a trust, distributing it to the family.
Yeah.
And the former spouse said, "Oh, by the way, I'd like that $700,000 in income that was distributed to me over the last 5 years that I never received."
Yeah.
And they went to court for that because the argument was, well, you did receive it. It was family income. It was spent with the family in mind and so on. And and they won that as the former spouse.
Yeah.
The entire amount had to be, I guess, paid or back paid, depending on how you look at it.
Unpaid. It's basically unpaid entitlements that are liability on the balance sheet.
That's right.
And that's, and it also introduced this idea of Div 7A loans, but I think that's different podcast completely and another 45 minutes to go into that one. And I think one of the biggest things that I think is always worth mentioning here is land tax. So because property is such a popular investment, we don't necessarily recommend it, but a lot of the people we work with already have it. In most states, holding a property in a family trust means you don't get the tax-free threshold for land tax. And I think that, and obviously that's one of the biggest expenses you have in Melbourne and Victoria at the moment. So it does come with these kind of little restrictions and drawbacks. But as we said, for those kind of complex clients, complex couples and complex families where they have multiple assets, multiple entities, this entity structure offers great flexibility.
Yeah. Well, flexibility, number one, but it'd be remiss of us, lastly, not to address, of course, you get the tax benefits, hopefully, and the tax flexibility. But there's another benefit that it can be really material for some people, which is around that concept of asset protection, right? So if you're working as hypothetically, you're working in a role whereby that carries litigation risk. Some point in the future, you might make a mistake, and if you were, then you could get sued potentially for a high amount of money. If that were the case, then having assets in a family trust can create a wall of separation between what is yours and therefore attackable via creditors versus what is another entity's, not mine. This is the Evans and Partners game all over again.
Because technically you're not the most important person in a trust is the appointer. And if you're not the appointer of the trust, or you're not the trustee of the trust, then you don't not necessarily deemed to control it, which means it doesn't necessarily form part of your asset base when it comes to these kind of, whether it's separations or whether it's administration, bankruptcy, and those sort of things.
Yeah, brilliant. Okay, so should you do it? There are, if you are the right candidate, this could be a brilliant thing for you with really meaningful long-term benefits. And alternatively, if for some people they might go through this process and realize that there's actually no benefit for them, and overall they're just paying an extra, call it $1,000 a year or thereabouts in accounting fees, perhaps more, in order to have this family trust looked after, and there's actually no advantage.
Yeah, exactly.
All right. It depends, huh? That's where
basically,
we landed. Yeah.
I mean, that's what I'm known for saying. So,
All right. Well, we are going to wind this one up. Thank you so much to everyone for joining us today, and looking forward to releasing more goodness to your ears next Thursday. Thank you, everyone.
Good to see you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.